Hello, everybody, and welcome back to our latest YouTube episode brought to you by Phenom Group and me, Seth Golden. We've got only four trading days left here in the calendar year 2020, and I'm sure for many, 2020 can't end quickly enough and 2021 begin. Just a heads up for this particular recording. I actually have an injury. I lacerated and punctured my tongue on Christmas Eve, so it's a little bit difficult for me to talk, but I'm going to do my best to, get through this video and deliver as much content, information, and research notes that I've been gathering over the last week. So hopefully it proves to benefit you and your positioning going into the new year and how you're looking at markets. With that being said, got a lot of charts to get to, so let's get right to it, folks. And hopefully my tongue can last through this episode. All right, something I've been talking about over the last week or so with our Phenom Group members in our live daily trading room is the fact that you're going to take drawdowns. Everybody takes drawdowns, folks. There's not a single trader that I've ever met, an investor that I've ever met, that has not taken a drawdown in their portfolio. So the question is, do you know how many investors throughout history that have never taken a drawdown? And again, this is not a trick question. We all take drawdowns. They are a normal part of the trading investing landscape. Drawdowns are smoothed out over time, however, and in accordance with a rising stock market. So this is a snapshot from inside one of my separately managed accounts within Golden Capital portfolio. And it shows you that back here in March, this is a year to date, back here in February through March, we were taking a drawdown. As you can see, the chart of the portfolio balance is going down. What I generally do when I see something like this, and I have a pretty good thesis of what's going on and what needs to happen to reverse the trend in the market, is I will call up our clients and ask them, do you want to increase your capital allocation to the market? 90% of our clients, they usually say yes. Why? Because they understand that drawdowns are temporary, corrections in the market are normal. And in this modern era of not only markets, but politics, there's really not a stomach. There's not a will when it comes to recessions and or bear markets. Fiscal policy seems to come to the rescue, if not monetary policy at the same time. And that's exactly what we saw back in late March into April. We saw the CARES Act package, and we saw the Fed, the central banks, cut interest rates all the way down to zero here in the United States. And many of the regions around the world, their central banks were also cutting rates as low as they could. But these fiscal and monetary measures have been quick to the rescue and served as our fundamental thesis to increase capital allocations to the equity market. And as you can see, that was this big thrust of fund flows into the account. And ever since, pretty much off to the races, rising to a year-to-date high. Even if you extrapolate those additional funds, the Golden Capital portfolio would be up about 28% this year so far. It's up almost 38% with the additional flows. In order for drawdowns to not become realized losses, sometimes the easiest thing to do is to just let the market play itself out. All these levers are going to be pulled, whether it's from the fiscal, monetary, or both sides of the equation, and just elongate your time frame. If you're somebody who tends to look at a trade as being, 1 week or 1 month or 1 quarter, you might just need to elongate your time frame in order to not take a realized loss. The longer our time frame is as an investor or trader, the more likely we enable realized profits and simultaneously lessen the probability of taking a loss. And here's a chart from Bank of America that basically says the same thing. As time horizons grow, equity losses plummet. Here's a day trader, 1 day. it's like a 50-50 shot on that trade for one day. 38% if you're thinking about a month. For a quarter, your likelihood of taking a loss goes down to 33%, so on and so on and so on as you elongate your time frame. Why? Because the market goes higher over time. Give yourself more time in the trade or investment, the greater probability that you're going to take a realized profit instead of a realized loss. Now, here's a fun fact I always like to throw out there. In the last 33 years, if you bought the IWM, the Russell Small Cap ETF, 3 trading sessions before Christmas, there was a higher close at some point in the next week, all 33 years. Fun fact, isn't it? For the SPDR ETF, or the S&P 500 Index ETF, it was higher at some point 31 out of 33 of those same years. We should expect higher prices, folks. All right, this snapshot here, this is basically showing you this 2020 rally off of the lows back on March 23rd is the greatest rally of all time. The greatest rally of all time. If you take the other rallies of consequence and of like significance, and you had the same starting point, they would not equate to what the S&P 500 has done in 2020, which is this squiggly line here. How did we achieve the greatest rally of all time? Well, we first had to have the fastest bear market in history. You add to that fiscal policy support, add to that monetary policy support, add to that we have a new economy in the way of the digital technology era, information technology era, and all of that stabilized the downturn. You add up all the sum of the parts and you get the greatest rally of all time. Let's keep it simple, folks. Another chart here from All Star Charts and JC Peretz. I love this chart because it is quite simple. And it basically shows you the S&P 500 is in an uptrend. The bond market is in a downtrend. Gold is in a downtrend. Keep it simple, folks. Stocks are in an uptrend, but when you're in an uptrend, you're going to get some consolidation periods. The current consolidation period basically started on December 8th. And so far, during this consolidation period where we hit the all-time high here, then we touched the 20-day moving average, but we closed above the 20-day moving average, rallied, made another all-time high, and since dropped below, intraday dropped below the 20-day moving average, and once again closed above the 20-day moving average and above 3,700 on the S&P 500 last week. Keeping in mind, folks, that we've now had back-to-back down weeks in the S&P 500. Oh, and I thought the market was, just relentlessly going higher. There are these periods of consolidation, just like what we saw in November, where we, off of the all-time high, we consolidated basically through over the next 2.5 weeks into December before breaking out once again to make new highs once again and go into another, what we can deem so far as a short-term consolidation phase. What we want to see is consolidation of the recent gains and then rally to new all-time highs again. Consolidation phases around the largest rebalancing period, which is where we are at the end of the year, are to be expected. What you do with consolidation, though, often lends to future portfolio performance. Again, bonds are in a downtrend, gold is in a downtrend. Not only are bonds in a downtrend, but the global bond index is on the verge of basically executing a death cross. What's a death cross? Well, a death cross is when the 50-day moving average, which is the faster of the moving averages, crosses below the long-term 200-day moving average, as you can see in the chart here. The 50-day moving average and the 200-day moving average. Bonds are out of favor. so far as price and or yield, I should say, and equities are in favor. Global bond index flirting with the debt cross. It is a lagging indicator. No, it doesn't always work, but it's still worth watching. I hear people all the time, everything is rallying. Well, yeah, it seems that way, especially across the equity universe, and that is the case. The MSCI All Country World Index hit an all-time high recently here, folks. Breadth and momentum are bullish factors for this everything rally. More than 80% of stocks around the world are above their 200-day moving average. That's this bottom chart right here, or the bottom panel here. You can see 80% or better around the world above their 200-day moving average. When this happened for the first time in more than 200 days, which is the case this time, global equities usually charged higher over the next 12-month or 1-year period. This study here by Troy Bombardier shows you what happens next to the MSCI All Country World Index when 83% of its stocks are above their 200-day moving average. 1 week later, it's pretty choppy, 50-50, basically, but not much of a return. 2 weeks later, it gets better, 86% of the time. 1 month later, 83% of the time, the market's positive, almost a 2% average return. 2 months later, 3 months later, folks, the longer that you go out in time, 6 months later, greater your chances are for a positive return, and the higher the return is likely to be. 9 months later and 1 year later, both double-digit returns, 100% of the time, after 83% of the stocks in the MSCI are trading above their 200-day moving average like they were this past trading week. So keep that in mind. Here's something that I tweeted out last week also. Perma bears versus logic. Here's the perma bear. Stock market is in a bubble. Eventually it will come crashing down. Logic. Was it in a bubble when it did the exact same thing that it's doing today from the March 2009 bottom? What happened after that 2009 bottom in March, folks? The market rallied for the next 11 years. So how is something in a bubble today when it's basically doing the exact same thing as it did back in 2009 with better earnings, a better earnings trend? And the drawdown in earnings from 2020 was not as steep as it was from 2008 to 2009. Perma bear, we can't go up in a straight line. Well, we haven't. Nothing ever does. Just because you're behind the 8 ball and you're positioned against the market doesn't mean that the market is going up in a straight line. It just means that you're focused on price, you're against the trend, and you're not paying attention to those consolidation periods whereby you can actually get involved in the market on trend as opposed to against trend. It hasn't. There have been 5 pullbacks of 5% or greater since the lows, and 2% plus drawdowns in less than 2 weeks. Remember, going back to this chart here in 2000, right now we have these 2, drawdowns. This one here and this one here. This one from the peak to trough was 2.25%. This one from the peak to trough intraday, where it broke below the 20-day, was 2.5%. So both greater than 2%, but less than 3%. Now, for those of you that watched the video that we did just a few weeks back, sentiment, leverage, put-call ratio, is it early 2018 again? Or is it the period that started late 2016 and lasted all the way to early 2018, where the S&P 500 did not draw down by greater than 3%? It stayed within 3% of its all-time highs for a record period of time. So, for those of you who haven't watched that video, I would strongly encourage you to watch that video and recognize that it may not be a coincidence that both the trend from late 2016 started in November, and so did this one when it came to certain of the indicators that we're watching that may lead us into a period like 2016 to 2018, where we didn't have a greater drawdown of, more than 3%. Is it a coincidence that this one's halted at 2.25% and this one halted at 2.5%? Is it a coincidence? Watch the video. You let me know. All right, so good stats there. Perma-bear logic isn't working. Perma-bears, once again, the market is overvalued still. Logic. Value is relative. Overvalued compared to what? The S&P 500 earnings yield is 2.5% greater than the 10-year Treasury. The risk-free rate. So you see that the risk-free rate is not where investors are. And yet you still overvalue. So everyone else is wrong? Okay. Perma-bear. It's all built on debt. Speaking of the market, I'm sure. Logic. Yes, our financial system is a credit leverage system since the very first Treasury issuance ever. So what's your point? That's the way it works. It's the way it works. Perma-bear, you'll see. Logic. Global stock index is at an all-time high. So it's not just me that will see, but it's going to have to be the whole world. Again, you're fighting the whole world. The MSCI whole world stock index is at an all-time high. Nonetheless, this is not the fight that you want to pick with the whole world if you're a perma-bear. How's breadth in the market? Well, breadth and the S&P 500 is pretty darn good. The 10-day total new highs minus new lows on the NYSE and the Nasdaq finished last week at its highest level since mid-2013. New highs tend to be evidence of strength, not weakness, folks. And here's the bullish percent on both the Nasdaq and the NYSE. How strong was market breadth as we look back to the previous week? Nasdaq and NYSE composites have both achieved extreme levels of participation or bullish breadth. Above 70 here, above 70 here on the NYSE, and this is the Nasdaq at 72. Breadth is a good indicator of future price. We should see new all-time highs in the not too distant future. Breadth is very strong. What happens next? Further strength. If history is any guide, even if not right away. Here's another chart and thinking about breadth or thinking about appetite. Like, what's appetite like? It's one thing for the market to be going up on strong breadth, but is the market going up on with risk on appetite, or is it the defensive sectors? So one of the ways that we can evaluate that is by comparing consumer discretionary with consumer staples. This is the relative performance of consumer discretionary versus consumer staples. Consumer discretionary tends to be more risk on. Consumer staples, those are your safety areas of the market, tends to insinuate risk off. And as we can see, it's been risk on. The relative performance is tilted to the upside in favor of consumer discretionary. So it is a risk on market. Now, keeping it simple and thinking risk on versus risk off. Consumer discretionary continues to lead consumer staples. I'm not always a fan, though, of using consumer discretionary ETF as a proxy of consumer strength or risk appetite. Why? And that's because two stocks make up 35+% of the consumer discretionary ETF. Amazon and Home Depot. Amazon making up like 25, 26%. Home Depot making up a good 10% or so. Two stocks. So what I rather do is use the equal weighted equal weighted consumer discretionary ETF. And that's ticker symbol RCD. Even when we look at the RCD, it's at all-time highs. It's hard to say that there's not risk on appetite. It's very difficult to say that when you have The equal weighted consumer discretionary ETF also at all-time highs and skirting, basically traveling its 20-day moving average. It's showing continued strength. Typically, this is a bullish sign for risk appetite. You want to be in the market, folks. I've showed this chart before. The market is up more than 77% of the time since 1928. 2020 was an anomalistic year in which we had a greater than 30% drawdown in the market. Only 3.2% of all years since 1928, 3.2% have had greater than a 30% drawdown. Very anomalistic. You want to be in the market. 77% of the time, the market is traveling higher. Last 10 trading days of the year, folks, tend to be strong days. Going back to 1945, the last 10 trading days have experienced a median gain of 0.93 with positive returns 73% of the time. We now have 4 trading days left in the year. Performance in the last 10 years has been similar to, going all the way back to 1945. In fact, they've been a little bit stronger where the median gain has been 1.04%. What about the Santa Claus rally? Santa Claus rally begins on the open on Christmas Eve day, December 24th, and lasts until the second trading day of 2021. Average S&P 500 gain over this 7 trading day range since 1969, pretty respectable 1.3%. And keeping in mind that we've had down weeks in each of the last 2 trading weeks. Last week was relatively flat. We were only down like 0.1% on the S&P 500, but it does set us up for some positive gains here going forward. Years when the Santa Claus rally has failed to materialize are often flat or down. The last 6 times the Santa Claus rally has not occurred were followed by 3 flat years. 94, 2004, 2015, and 2 nasty bear markets, 2000 and 2008. A mild bear that ended in 2016. Since 1980, from close before Christmas through second trading day of New Year, S&P 500 has been higher 28 out of 40 times by 1.92% average gain. The 12 times lower by average of 1.8%, pretty close to the gain. But in the 21 days following the 12 failed Santa Claus rallies, S&P 500 rose 8 times, 3.7% average, and fell only 4 times, 4.2% average. Pretty asymmetric risk. Here's something also you should consider. Black Friday week. We were up more than 1% on Black Friday week. And here's a study from Schaefer Research. Black Friday week, if you're down 1% plus, the next 3 months, market return was down almost 5%. Black Friday week, if the week was flat, the average return over the next 3 months was up 2.23%. 71% of the time. But remember, we were up greater than 1%. Number of returns, 11 times that has happened in the past. The next 3 months, the market rallied another almost 4%. Positive, 81.8%. History's on our side, folks, if you're a bull. It suggests there's more to come. The market is too expensive, right? That's what we hear from perma bears because we're basically, the forward P ratio is at levels it hasn't seen since the dot-com era. But that sentence is never complete when somebody says that, the valuation is too high. You have to put it in perspective. It's relative. Value is always relative. Relative to what? What are you comparing it to? So investing is the art of risk-taking, with the greater consideration being where is the best yield to be extrapolated over time. What many always consider firstly is whether the S&P 500 is expensive or cheap within the context of the best yield. Where can I find the best yield? The S&P 500's forward PE is still hovering near highest since dot-com era, suggesting an expensive market. But earnings yield for the S&P 500 is 2.5% greater than the 10-year Treasury yield, suggesting this is not an expensive market. Where else are you going to go? You don't have to like that we live in this TINA market. There is no other alternative. You don't have to like it, but that is the reality. Where else are you going to go? Value is always relative, folks. S&P 500 earnings yield minus the 10-year Treasury yield gives you the equity risk premium. And this is where you want to be. We are at lofty levels when it comes to the equity risk premium, which suggests that the best yield is still going to come from the equity market. And the dollar's falling. The dollar is at levels it hasn't seen since 2018. It broke below 90 last week briefly before, having another dead possum bounce. So you have a weaker dollar, which is going to support S&P 500 earnings going forward as well. Not only that, but you've got the 10-year Treasury yield minus the 2-year Treasury yield, also known as the yield curve, steepening to its, the steepest level it's seen since October of 2017. This provides another catalyst for bank earnings or bank profit margins. These are all tailwinds for earnings in 2021. These are all tailwinds. If you don't like lofty valuations, you better change the year-over-year path of the dollar and avoid looking at how steep the yield curve is. And by the way, most major banks or major institutions are forecasting the yield curve to steepen that much further in 2021, possibly by upwards of 150 basis points. Right now we're at 82 basis points, so nearly double where it is today. So if you're a perma bear, you got to look away because all you're seeing are tailwinds for earnings out into 2021. These are very powerful tailwinds, folks, which is probably why we've been seeing a lot of, equity ETF inflows over the course of December. I mean, here you can see right there, because the S&P 500 yield is so much higher than what we can capture in the bond market, equity ETF flows have remained strong here in December. After 80 billion of inflows in November, equity ETFs have seen another 45 billion so far in December. There are a ton of people going gaga over stocks right now. Here's another study from Troy Bombardier. One of the most important medium-term indicators I look at is the S&P 500's percentage change from the 2-year low. It's a pretty big rate of change there, folks. This is a bearish indicator, generates a signal once in a decade. Investors need to be extremely vigilant when it triggers a bearish signal. This signal indicator currently stands at 66%, the rate of change 66% off the 2-year low. An extreme reading which almost always led to stock market losses over the next 2 to 3 months. Again, time frames matter. 2 to 3 months is not a long time, folks. If we're actually not going to look like 2016 to early 2018, and maybe we're going to look like 2012, right? Because we basically did the same thing off of the March 2009 bottom into 2010. So maybe that is what we're going to see. 2020 into 2021 look like the correction that we had in the first quarter of 2010. Given this particular indicator, it says 1 week later, stocks are okay, but not much of a gain. 2 weeks later, it's a toss-up. 56% of the time the market was positive, but negligible gains. Market was still positive on average after a 66% rally off of a 2-year low, but only 33% of the time. and then we were down 2 months later by almost 2%, down 3. Well, we were up 3 months later, but again, only 44% of the time we were up. When you start to elongate your time horizon, 9 months later and 1 year later, positivity rate increases and your average return increase as well. So do keep this in mind. We have rallied significantly. Nobody doubts that. Nobody denies it. The thing that there are many differences, though, from the 2009 bottom into 2010, where you have this show up here, folks. See, 2009, and all positive returns there 1 year later. A more dangerous point is actually when the S&P 500 rallies 75% from a 2-year low, which is only about 5% gain from where the S&P 500 stood as of last week's close. So we need to get to 39.15 to get a 75% gain. Doubtful that's going to happen. But here's the study, just in case. And again, it's not very favorable. 2 months, 3 months, even 6 months later, all negative returns. So if anything, we want to continue this choppiness in the December period, but with a tilt to the upside. Just not a robust move. All the historical cases saw the S&P 500 rally further in the short term, but more importantly, the S&P 500 eventually fell enough to erase those gains. That's this 2 months, 3 months, and 6 month time period. All right, something that I hear all the time lately is, I don't want to buy at the all-time highs. I don't want to buy at the all-time highs. I don't want to buy at the all-time highs. I'm going to wait for a pullback. A, you're not going to wait for a pullback. B, it actually is better to buy at the all-time highs. And here's your study from JP Morgan. The average cumulative S&P 500 total returns January 1st, 1988 to present, if you invest on any day versus investing at all-time highs. All-time highs, you had a greater return 1 year later. All-time highs, a greater return 3 years later. All-time highs, a greater return 5 years later. Then if you had invested on any other day. And why? Generally because, the market, returns are stronger after all-time highs because rising prices attract more buyers, which leads to higher prices. This tends to continue until something comes along and knocks the cycle off its course. But the data doesn't lie. If you're waiting for a pullback, it's just not the best strategy. Sam Lee looked at it as well, because I hear people also saying, well, this market's going to crash. We're in a bubble. The market's going to crash. We rose 68%. And the market has to crash from here. Look at the COVID cases. Look at the economy. Look at jobless claims, right? So they think the market has to crash. They think the market and the economy are one and the same as well. But Sam Lee looked at a simple methodology to demonstrate what a terrible idea it is to wait for a market to crash. A simple version of the strategy is to wait for a 10% peak to trough loss before buying, then holding for at least 12 months or until the drawdown threshold is exceeded before returning to cash. For each percentage point of volatility, buy the dip yielded only 0.14% in additional annualized return, and a buy and hold yielded 0.34%. The buy and hold did better than the buy and dip. Again, data doesn't lie. Buy and hold is not the only way to invest, granted, but waiting for the market to crash is no way to invest at all. It's exhausting. And more likely than not, you're not going to buy the dip. You're going to be scared just like everybody else. You won't actually buy, and it just flat out doesn't work. Investing in uptrends is a lot easier to do. All right, this chart right here, shows you again, the 40-week period. This is a 40-period weekly rate of change. When you get above this line here, folks, good things happen in the market. This goes back to the 1970s, off of a major bottom here with a significant momentum thrust above this dotted line here. The rally persisted for the next about 10 years, until about 1978, we'll call it. We had a nice dip here, another 40-period weekly rate of change or momentum thrust, carried the market significantly higher. From we'll call it 1978, so basically 2000. Did you really want to miss this by waiting for the market to crash? We had a significant momentum thrust in 2009 that lasted until this year, 2020, and again, just had the same 40-period weekly rate of change. Fire. More than likely, this is going to be another multi-year uptrend within a secular bull market, folks. Into the year end, we expect some choppiness. We expect equity rebalancing flows, presenting a headwind into the end of the year. Some of the late day action that we've seen, where we've had gains through much of the day last week, and then most of those gains were completely, eradicated to finish roughly unchanged on the day. A lot of that is due to year-end rebalancing. This is a normal market operation that happens at the end of the year. I view any near-term weakness as opportunity, as it will likely prove a normal market operation associated with year-end rebalancing. Last week, we had a significant announcement in the way of the Fed allowing banks to reinstitute their buyback plans, and pretty much all of the big money center banks did just that. Looking for tailwinds? Again, this is another significant tailwind for 2021 when compared to 2020, where buybacks were not really part of the equation. The S&P 500, the S&P Dow Jones Indices recent report on buyback activity for Q3 shows buyback activity did increase to $101.79 billion from $88 billion in Q2. Here you can see in the chart, the red line is 2020, folks. This is buybacks in 2020, significantly lower than where they used to be. The green line, this line right here, is, buybacks and dividends, is also still very much lower than where it was in 2018 at the record highs. Dividends actually decreased to $115 billion in the third quarter versus $119 billion in the second quarter. On a year-over-year basis, dividend payments are down 6%, and dividends with buybacks combined are down 27% year over year. Banks have started their buybacks again. Free cash flow should be in a better position in 2021 when the economy fully reopens and we see the service sector come back. These are significant tailwinds. A lower dollar, lower rates, buybacks, dividend increases. These are all on the horizon, folks. It's a steepening yield curve. Know what your tailwinds are. Now, in knowing what your tailwinds are, you also want to know what your risks are for 2021 as well. Goldman Sachs outlined 3 downside risks. First, the vaccine distribution does not go as smoothly as we expect or have the economic impact we expect. Let's be honest, so far, it hasn't gone as smoothly as I would say the administration has led us to believe it would. But it seems like the administration is more focused on overturning the election at this point than it is on the vaccine rollout and or COVID in general. It is what it is. We'll see what happens going forward. But now we also have the Moderna vaccine, and we're likely to get the AstraZeneca Oxford vaccine approval this week, if not in the new year. the first week of the new year. We'll have 3 vaccines. And this is before we even get to the Johnson & Johnson vaccine, which is now forecasted to possibly be approved at the end of January. That's a one-shot vaccine for which there are, hundreds of millions of doses, waiting to be delivered. The second, fiscal and monetary policy drive a sharper than expected rise in inflation and interest rates. I'm very skeptical about, sharper than expected rise in inflation. Folks, for every year that we've feared inflation, it just hasn't arrived. And that's a reflection on the information technology era, which basically, where you find inflation starting to stir, if you will, price transparency through information technology and mobile devices basically extrapolates that inflation potential out of the market. And I don't see the Fed, even if we do get to their threshold of 2% on the PCE. I'm very skeptical that they will, raise rates or feel that such an achievement of a 2% on the PCE rate threshold there is anything but transitory. Anything but transitory. I mean, they've given themselves a lot of leeway when it comes to the potential of raising rates in the future. Quite frankly, and I've said this before, I'm of the opinion they're never going to raise rates again. They've essentially come to a point where they recognize rates they don't do it. They don't do the job. They don't combat recessions the way that they used to, if they ever really did. And it's just a futile effort when you're raising rates because of, what happens when the next recession arrives? I mean, you're going to just drop it to zero. So what's the point? Third, the policy uncertainty weighs on U.S. equities. Okay, we have a new White House administration coming in. What is the prospectus around taxation, corporate and income tax? How is the new administration going to deal with China? How are they going to foster trade deals that we basically exonerated or left, over the last 4 years? So I can understand that perspective, but I'm actually not of the opinion that these are going to be any more than blips should they arrive as headwinds for the market. So should we see, the Democrats take both of the Georgia seats in the runoff election even, and that's going to heighten the awareness of, what is the, Biden administration corporate and income tax policy going to be? I would expect the market to, throw a bit of a tantrum, but allow opportunity to develop for long-term investors. You want to be buying that dip. Bitcoin, right? So everybody's talking about the melt up and, market might be in a state of, of euphoria, if you will. Ed Yardeni likens these to the sentiment indicators showing that the melt up in the price of Tesla and the price of recent IPOs is yet another sign of irrational exuberance. Furthermore, with all due respect to Bitcoin fans, Ed Yardeni says, I view it and other cryptocurrencies as digital tulips. I have no way to value them. I prefer assets with earnings, dividends, coupons, and rents, an income stream I can value. Nevertheless, I do watch Bitcoin's price action as a gauge of speculative excesses, which are back at record highs, according to this gauge. Here's all your price targets for the year-end 2021 from all of your different analysts and strategists. Right now, it looks like 3,800 is the low from Bank of America, Savita Subramanian. And she's been behind the curve this whole rally. Go figure, she has the lowest price target for next year. These are their 2021 EPS estimates. Look at Deutsche Bank's Bankum Chada. He's at $194 in earnings. And I did want to harken back to 2008, 2009, folks. This is the quarterly earnings well, drawdown, unfortunately, for 2008. The March quarter, down 27% in earnings. The June quarter, 39, September, 41, 77% in December. March, 88, June of 2009, 85, September, down set. It wasn't until the final quarter of 2009 that earnings came back substantially. Obviously, these are massive drawdowns in earnings, massive. So you're going to have a massive relief rally in earnings, up 788%, 793%, and then things start to normalize. Obviously, this is setting a very high bar when you grow earnings this substantially off of a very low base. But in looking at 2009 and 2008 drawdown in earnings, now let's look at 2020, folks. We dropped 13% here and 26% here. That's it. It's not as bad as 2009 and 2008. The market is rational. It is efficient, despite what people might say. Well, you only got those earnings because of the monetary and fiscal, policy implementations. It is what it is. You don't have to like it. But that is your reality as an investor. Those levers did facilitate less of a drawdown in earnings on a year-over-year basis. That's the market you have. It's not always the market you want. It may not be ideal, but it is your reality as an investor and trader. Don't be your portfolio's problem by doing the following. Let's fight the Fed. No, let's short Bitcoin and Tesla. History should not be used to aid in our path forward. Really? History has been a very useful guide and showed its worth, in so many ways throughout this post-pandemic period. When in doubt, go long volatility. Say what? Yeah, that's not the side of the coin you want to be on either. Adopt a perma-bear philosophy. That doesn't work, folks. Defy the uptrend. That doesn't work either. And when all else fails, I grew up in the 80s. Blame it on the rain. Blame it on the rain. For those of you who remember Milli Vanilli. So these are the things you do not want to be doing in your portfolio. So a while back, we had recognized that what goes up, quite frankly, keeps going up. Last year, the S&P 500 delivered a 30+% return. What happens after the S&P 500 delivers a 30% annualized return? Well, historically, dating back to 1950, the average return over the next 12 months is 15%. We're up just about 15% this year. You want to talk about history, proving a very valuable resource. This is yet another validation of that being a valid and valuable tool. Can the Nasdaq, here's another one. Can the Nasdaq have 3 years of double-digit returns in a row? It was up more than 20% last year. It's up 40% year to date. So this study is from DataTrek. With the Nasdaq composite up hefty double digits year to date, after a double-digit total return last year, what are the odds it can return another 10% plus return in 2021? The Nasdaq Composite had posted 2 consecutive years of more of an annual double-digit price returns 14 times since 1972. And this year will bring that to 15. So it's had back-to-back double-digit gains now, including 2020, 15 separate times since 1972. In the year after those 14 instances, the Nasdaq was positive just over half the time and up an average of 10% on a price basis. Bear in mind that average was heavily skewed higher by the 1990s experience. For example, the best return was 85% in 1999. The worst was negative 39% in 2000. The Nasdaq went on to produce a positive double-digit return for a third year in a row during 4 separate periods: 1978 through 1980. In 1978, up 12.3%, 1979, 28.1%, 1980, 33.9%. So again, this is really just demonstrating that you can be in an uptrend for a lot longer than you expect. Don't play, don't be the guy who's trying to call the top in the market. More than likely, you're going to be wrong. There's no fruit in that exercise. You simply want to look for periods where you can add equity market allocation or exposure on consolidation of those gains. 1991 through 93, look at these gains here. 95 to 99, very strong gains. 2012 to 2014, up 16%, 38% in 2013, and another 13% in 2014. Speaking of the economy, segueing just a bit here, the Chase consumer card spending, and we got the rather rough month-over-month retail sales report recently showing a drop in the month of November of 1.1%. Do keep in mind that's month-over-month. The year-over-year was still up by more than 4% in November retail sales. Year-over-year, retail sales rose more than 4% as of November. We're still hitting record levels in retail sales every single month, despite the pandemic, despite rolling regional economic restrictions and stay-at-home orders. We're still hitting all-time highs. But the month-over-month is the headline, and that has not fared well over the last 2 months. They've both been negative. Having said that, I think we have some strong tailwinds for which we can see personal consumption growth in 2021. The first one is wage and salary income. They should all be higher next year. Naturally, we have a very low base here in 2020. Fiscal stimulus, it's a tailwind, whether you like it or not, and I realize that the president hasn't signed it into law just yet. Maybe that's going to come Monday. Maybe it won't come, until the new administration, but it will come. And when it does, it is going to provide a stimulus for economic growth going forward. We can see here, this is from Bank of America. This was their previous estimate of GDP. The Q1, this was their previous in the dark, but with the stimulus, this is the new estimate. Q2, not as robust. Q3, Q4. This was all for 2021, but now, this was all 2020 after the stimulus, and here's 2021, the new estimate with stimulus. So another thing is personal savings rate. It's still extremely high, folks. The household consumer balance sheet is strong. They have a very high savings rate. Wealth, well, stock market is at record levels. The people's 401ks, their private brokerage portfolio, they're hitting record levels. So the wealth effect is there. Real estate values have been climbing steadily all year long. We have a historically low level of housing inventory available, which is continuing to aid in real estate values moving higher. This is all the wealth effect that we can see as a positive tailwind for personal consumption out in 2021. Debt. In aggregate, U.S. consumers are over a decade into deleveraging cycle that has brought the ratio of debt to disposable income back to levels last seen in the 1990s. It's actually at its lowest levels in history. You have to go back to when this first became a metric in 1968 or 1969. The household balance sheet is in its best shape it's ever been because we've gone through this great deleveraging period here after the previous, the great financial crisis and housing bubble burst. So when it's all said and done, You know, my stock market positioning starts and ends with the long-term trend. And that trend is in place, folks. I wouldn't be fighting it. If anything, I would be looking for opportunity. And that opportunity comes during consolidation periods. We're currently in a consolidation period. We don't know when that consolidation period will end. Are we just going to ride the 20-day moving average in the S&P 500? Or are we going to test the 50-day moving average in the S&P 500? All of that remains in question. But breadth remains strong. Fund flows remain strong. And it suggests you should be a buyer on dips. We're going to get through this period where, you know, the vaccines are more widely distributed. We're going to have more vaccines to distribute. And we're going to get fiscal relief heading our way. I think the best practice right now, instead of trying to call tops, is look for those stocks on your shopping list, or develop your shopping list that much further in order to take advantage of any near-term weakness should it come to pass. Last but not least, again, 2.25% drawdown before we popped, 2.5% drawdown. You're gonna want to watch this video here, folks. Sentiment, leverage, put call ratio. Or is it early 2018 again, where we're going to have a nasty 10 to 13% correction in the first quarter of 2021? All right. Thank you for joining us here on our latest video from Phenom Group, and we'll see you back here again later this week.